Good morning, friends. Welcome to this session on integrated risk management. I'm sorry for the hiccups that we had today. It does not happen normally. He is an ex-general manager from Bank of Baroda, and he is also a PhD in banking, and he is right now a professor in risk management. And we are very privileged to hear him today.
Overview of how the risks, integrated risk management can be implemented at the grassroots level. And all of us know very well the risk. Let us again recall our primary knowledge about risk management. That is what we normally start with. What is risk? And that is the macroeconomic and business environment. And in a globally integrated economy, we will have external sector risks, which are very, very uncertain. So when these three fuse together, then a risk can precipitate in the organization. It can be internal, future. So whenever we talk of risk management, that means we are trying to penetrate through the future, and hence forecasting and predictive analysis comes into focus. Returns and the anticipated returns, they come closer to each other. That means the actual return should be very close to the anticipated returns. So that is what we will always be looking for. So when we do a host of activities, manage the risk. Then what is the importance of risk? The importance of the banks are cornerstone institutions of national and global system, and they should have the ability to manage the risks in the environment. This is because if they fail, it slows and halts. We have now neobanks, that is virtual banks. We have tech insurance companies, and many startups are there, and many service providers in the financial system are there. Then product diversity takes place. Whenever the product diversification takes place, risks automatically precipitate. Then the larger role of ICT, that whatever role the information communication and technology used to play earlier, now we have higher information and communication and technology role in our day-to-day operations, because 65 to 70% of the banking operations are now 2025. So we should progressively revisit our systems, procedures, business process re-engineering, and systemic controls, and training the staff, and giving some kind of sensitization. All these things is a ongoing process, because we must always assume, as of now NPA positions are good, but then we will have to see how going forward, how it will pan out. And negative real rates of interest at that time, and now, of course, now also real rate of interest are not very good, but still in a developing country, it is an accepted phenomenon that inflation and growth rate, how to whenever the actual earnings are less than expected earnings, then it is a downside risk. That is, the risk has precipitated. Environment, arbitrage opportunities disappear as soon as they appear. So if there is an upside risk, it is going to be neutralized, because the smart players will come into play. They will start making money, and then it will be neutralized. So upside risks are very, very temporary, but we can make some money during that time. These have perished forever from the radar of the financial system. So then came Basel III in 2010, which has imposed what is known as 2.5% of capital conservation buffer in addition to the capital that we have. So, my dear friends, if we are in a position to manage our credit risk, because our CD ratio will be somewhere around to the bottom. Like now, I have placed operational risk at the as the third element. But with the advent of technology, with the advent of importance of people in decision making process, it is not that earlier we were not making decisions, but now data driven decision making system